Right now, as you're watching this, something extraordinary is happening in the silver market. And I need you to understand what's at stake in the next 48 hours, because this window won't stay open much longer. The silver market just hit a price level that hasn't been seen in decades. We're talking about a metal that's been in a structural supply deficit for 5 consecutive years. Think about that for a moment. 5 years where the world has consumed more silver than it's produced. That's not a temporary imbalance. That's a fundamental shift in the market structure itself. And here's what makes this 48-hour window so critical. We're at an inflection point where institutional money is starting to flood into silver at levels we haven't witnessed since the early 1980s. But unlike that era, this time the supply situation is far more dire. Let me paint you a picture of what's really happening behind the scenes. The Silver Institute just released data showing that industrial demand alone is consuming silver at unprecedented rates. We're not talking about investment demand yet. That's a separate category entirely. This is actual physical silver being permanently removed from the market for manufacturing electronics, solar panels, and electric vehicles. Silver that's never coming back into circulation. Solar panel manufacturers are now the single largest industrial consumer of silver, and their appetite is insatiable. Every solar panel requires about 20 grams of silver. Sounds small, right? But when you're producing hundreds of millions of panels annually to meet global renewable energy targets, that adds up to hundreds of millions of ounces. And those panels have a 25-year lifespan. That silver is locked away for a generation. Electric vehicles are another massive drain. Each EV uses roughly twice as much silver as a traditional combustion engine vehicle. And we're not talking about a gradual transition here. Major economies have set hard deadlines for phasing out gas-powered vehicles. That means the silver demand from the automotive sector alone is set to double, then triple, then quadruple over the next decade. But here's where it gets really interesting. While industrial demand is soaring, mine production is actually declining. The world's major silver mines are aging. The easy-to-extract deposits were mined decades ago. What's left requires more energy, more capital, and more time to extract. And many of these mines are in politically unstable regions where production can be disrupted at any moment. Mexico, the world's largest silver producer, has been dealing with infrastructure challenges and regulatory changes that have slowed output. Peru, the second largest producer, faces similar issues. Together, these two countries account for nearly 40% of global mine supply. When they sneeze, the silver market catches pneumonia. Now let's talk about what's happening in the investment world, because this is where the 48-hour urgency comes into play. Central banks around the world have been accumulating precious metals at record pace. While gold gets most of the headlines, silver is quietly being accumulated by institutions that understand its dual nature as both an industrial metal and a monetary asset. These aren't retail investors making emotional decisions. These are sophisticated institutions with research teams analyzing every data point, every supply chain disruption, every geopolitical risk, and they're buying aggressively. The COMEX, the primary exchange where silver futures are traded, is showing something remarkable in its positioning data. Commercial traders, the big banks and institutions that typically bet against price rallies, have dramatically reduced their short positions. In plain English, the smart money that usually profits from silver going down has stepped aside. They're not fighting this rally. That's a massive signal. When the commercial traders stop shorting silver, it means they see something in the supply-demand fundamentals that makes betting against the price too risky. These are the players with the deepest pockets and the best information. They don't step aside lightly. Meanwhile, the managed money category, hedge funds and large speculators, have been building long positions. But here's the kicker. Their positioning isn't anywhere near the extremes we saw in previous bull markets. There's still enormous room for speculative money to pile in, and when that happens, when the momentum traders and trend followers start chasing silver higher, the moves can be explosive. Let me take you back to a specific moment in history that rhymes with what we're seeing today. In 1979, silver was trading around $5 an ounce. The world was dealing with inflation, geopolitical tensions, and a crisis of confidence in fiat currencies. Sound familiar? Within 18 months, silver had rocketed to $50 an ounce, a tenfold increase. Fortunes were made by those who recognized the setup early. But here's what's different this time. and why this might be even bigger. In 1979, silver wasn't critical to the global economy's infrastructure. It was primarily a monetary metal and had some industrial uses, but nothing like today. Now, silver is absolutely essential to the green energy transition, to electric vehicles, to 5G networks, to medical applications. The industrial demand floor is vastly higher than it was back then. And the supply situation? Far more constrained. In the late 1970s, there were massive above-ground stockpiles of silver that could be mobilized when prices rose. Governments had strategic reserves. Today, those stockpiles are largely depleted. The silver that exists above ground is either in jewelry, in industrial products, or in the hands of investors who understand its value and aren't selling at these prices. Quick aside here, if you're sitting on a significant retirement account, say $100,000 or more, and you're concerned about inflation and currency debasement, I've put together a comprehensive guide on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, and why that might make sense given what we're seeing in the markets. Worth checking out if that's relevant to your situation. Now back to why the next 48 hours matter so much. We're at a technical price level that's been resistance for years. Every time silver has approached this zone in the past, it's been beaten back down. But this time, the buying pressure is different. The volume is different. The fundamental backdrop is different. Technical analysts call these moments breakout points. When a price finally breaks through a long-term resistance level with conviction, it often triggers a cascade of buying. Stop-loss orders from short sellers get triggered, forcing them to buy to cover their positions. Momentum algorithms detect the breakout and start buying. Retail investors who've been waiting on the sidelines see the move and jump in, not wanting to miss out. This cascading effect can push prices much higher, much faster than anyone expects. And once that momentum gets going, it feeds on itself. But here's the critical part. Breakouts can fail. If the price doesn't hold above this resistance level, if it falls back below, all that buying pressure evaporates. The shorts come back in. The momentum traders exit. The opportunity closes. That's why these next 48 hours are so crucial. We're right at that inflection point. The market is deciding right now whether this is a genuine breakout or another false start. Let me share what some of the smartest analysts in the precious metals space are saying. One prominent metals analyst recently pointed out that the silver-to-gold ratio, how many ounces of silver it takes to buy 1 ounce of gold, is still near historic extremes. Right now, it takes roughly 80 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged closer to 60-1, and during silver bull markets, it's compressed to 30-1 or even lower. What does that mean in practical terms? It means that even if gold just stays flat from here, silver has room to double or triple just to get back to historical norms in the ratio. And if gold continues rising, which many expect given the global monetary situation, silver could go much higher. Another analyst I follow closely has been tracking the physical silver market, specifically what's happening at the retail level. Coin dealers are reporting unprecedented demand. Premiums, the amount above spot price that physical silver commands, have been elevated for months. That's a sign that the physical market is tight. When you can't easily buy physical silver at spot price, when you have to pay significant premiums, it tells you there's a shortage in the retail distribution chain. And it's not just retail. Industrial users are reportedly securing long-term supply contracts at fixed prices, locking in their silver needs for years ahead. That's not normal behavior. Companies don't lock in long-term contracts unless they're worried about future availability or price spikes. They're essentially buying insurance against a supply crunch. Now let's talk about the elephant in the room, the paper silver market versus the physical silver market. The vast majority of silver trading happens on paper. Futures contracts, ETFs, derivatives. These are claims on silver, not actual physical metal. And here's where it gets interesting. The amount of paper silver that trades is many multiples of the actual physical silver that exists. Think of it like a game of musical chairs. As long as everyone's happy holding paper claims, the system works fine. But what happens when people start demanding physical delivery? What happens when industrial users, investors, or institutions decide they want the actual metal, not just a contract promising future delivery? That's when the music stops, and there aren't enough chairs. We've already seen glimpses of this dynamic. A few years ago, there was a massive short squeeze in silver that sent prices soaring in a matter of days. Retail investors coordinated buying of physical silver and silver ETFs, and the market couldn't handle the demand. Premiums exploded. Dealers ran out of inventory. Mints couldn't produce coins fast enough. That was a preview, a small-scale test of what happens when physical demand overwhelms the paper market structure. And it happened with just a fraction of the investment community participating. Imagine what happens when institutional money, pension funds, sovereign wealth funds, family offices, decides they want physical silver exposure. The amounts they deploy would dwarf anything we saw in that previous squeeze. We're talking about billions of dollars trying to chase a market that's relatively small compared to other asset classes. The entire above-ground investment-grade silver market is worth maybe $50 billion. That sounds like a lot until you realize that's less than the market cap of many individual tech companies. It's a rounding error in the global bond market. It's a tiny fraction of the money sitting in money market funds earning minimal returns. If even a small percentage of that capital decides to rotate into silver, the price impact would be enormous. There simply isn't enough physical silver available at current prices to satisfy that level of demand. And here's another factor that's often overlooked. Silver mining is largely a byproduct of other mining operations. About 70% of silver production comes as a byproduct of mining for copper, lead, zinc, and gold. That means silver supply isn't very responsive to silver prices. Even if silver prices double, you can't just open new silver mines quickly because most silver isn't mined primarily for silver. This creates an unusual supply dynamic. In most commodity markets, when prices rise, producers increase output, which eventually brings prices back down. But with silver, that mechanism is broken. Higher prices don't necessarily lead to significantly more supply, at least not quickly. It takes years to bring new mining capacity online, and again, most silver comes from mines that are primarily producing other metals. So you have surging demand from multiple sources, industrial, investment, monetary, hitting a supply structure that can't respond quickly. That's the recipe for a price spike. Let me tell you about what happened in 2011, because there are some eerie parallels to today. Silver started that year around $30 an ounce. By April, it had rocketed to nearly $50. The move was driven by a combination of factors: concerns about currency debasement after massive central bank money printing following the financial crisis, strong industrial demand from the recovering global economy, and a wave of investment demand from people seeking inflation protection. But here's what's different now. The supply deficit is much worse. In 2011, there were still above-ground stockpiles that could be mobilized. Today, those are largely gone. The industrial demand is much stronger now because of the green energy transition, and the investment demand hasn't even really started yet. We're still in the early innings. Some analysts are projecting that silver could reach $100 an ounce or higher in this cycle. That might sound outlandish, but when you look at the fundamentals, it's not as crazy as it seems. If silver just returns to its inflation-adjusted high from 1980, we're talking about prices well above $100. And that's before accounting for the much stronger industrial demand picture today. But here's the thing about these moves. They don't happen in a straight line, and timing matters. Silver is volatile. It can drop 20% in a week, then rally 40% the next month. The traders who make money in silver are the ones who position themselves before the major moves, not the ones who chase after the price has already run. That's why this 48-hour window matters. We're at a decision point. The market is either going to break out to new highs and potentially start a major bull run, or it's going to fail at resistance and pull back, giving everyone another chance to position at lower prices. But if it does break out, if we do see a sustained move above this resistance level, the next leg higher could be swift and substantial, and by the time it's obvious to everyone that silver is in a bull market, the easy gains will already be gone. Let me share something that a veteran precious metals trader once told me. He said, "The best time to buy silver is when nobody's talking about it. The worst time is when everyone's talking about it." Right now, we're in that transition phase. Silver is starting to get attention, but it's not mainstream yet. CNBC isn't leading with silver stories. Your neighbors aren't asking you about silver. That's actually the sweet spot. Think about the psychology of markets for a moment. When does the average investor buy? They buy after something has already gone up significantly, when the story is everywhere, when they feel like they're missing out. That's human nature. But that's also how you end up buying near the top. The smart money, the institutions, the experienced traders, the people who consistently make money in markets, they buy when things are still uncertain, when the story isn't obvious yet, when there's still risk. They buy the setup, not the result. Right now, we have a setup. The fundamentals are screaming that silver is undervalued relative to its supply-demand dynamics. The technical picture is showing a potential breakout. The institutional positioning is shifting. The macro environment, inflation concerns, geopolitical tensions, currency debasement, favors hard assets. But it's not a sure thing. Nothing in markets ever is. That's why it's still a setup and not a guaranteed outcome. The price could fail at resistance. We could see a pullback. The breakout could be delayed. But here's what I know. The underlying fundamentals aren't going away. The supply deficit is real. The industrial demand is real. The depleted stockpiles are real. Even if the price pulls back in the short term, those fundamentals will eventually assert themselves. The question is whether you want to position yourself now, during this 48-hour window where we're at a critical juncture, or whether you want to wait and see what happens, potentially missing the move if it does break out. Let me give you another historical example that illustrates this point. In 2008, during the financial crisis, silver crashed along with everything else. It went from around $20 an ounce down to $9. People were panicking. The world felt like it was ending. But a small group of investors recognized that the response to the crisis, massive money printing, zero interest rates, unprecedented fiscal stimulus, would eventually be bullish for precious metals. Those investors bought silver in late 2008 and early 2009 when everyone else was selling. It felt scary. It felt risky. The headlines were all doom and gloom. But they understood the setup. By 2011, silver had gone from $9 to nearly $50. The investors who bought during the crisis made 5 times their money. The ones who waited until it was safe, until the trend was obvious, made far less or even lost money buying near the top. The lesson isn't that you should try to catch falling knives or buy during crashes. The lesson is that the best opportunities often come when there's still uncertainty, when the outcome isn't obvious yet, when you have to do your own analysis and make a decision based on fundamentals rather than following the crowd. Right now, with silver at this critical technical level, with the fundamentals as strong as they are, with institutional money starting to flow in, we have one of those moments. It's not a crash scenario like 2008, but it's a decision point where the next move could be significant. And here's something else to consider: the opportunity cost of waiting. If silver does break out and start a sustained rally, you're not just missing the gains, you're also missing the compounding effect of being positioned early. The difference between buying at $30 and buying at $40 might not seem like much, but if silver goes to $80 or $100, that initial entry point makes a huge difference in your returns. Plus, there's the psychological factor. It's much easier to hold through volatility when you bought at a good price and you're sitting on gains. It's much harder when you chase the price higher and you're underwater on your position. Your entry point affects not just your returns, but your ability to stick with the position through the inevitable pullbacks. Now, I want to address something important. This isn't financial advice. I'm not telling you what to do with your money. What I'm doing is laying out the facts, the data, the market dynamics, and the historical context so you can make an informed decision for yourself. Everyone's situation is different. Your risk tolerance, your time horizon, your financial goals, those are all unique to you. What makes sense for one person might not make sense for another. But what I will say is this: if you're interested in silver, if you've been watching the market, if you understand the fundamentals we've discussed, then this 48-hour window is worth paying attention to. This is a moment where the market is making a decision, and that decision will likely set the tone for the next several months. Whether you decide to act or not, At least you'll be making that decision with full information, understanding what's at stake and why this particular moment matters. Let me bring this back to the bigger picture for a moment, because silver doesn't exist in a vacuum. What's happening in the silver market is part of a larger shift in the global financial system. We're living through a period of unprecedented monetary experimentation. Central banks have printed trillions of dollars, euros, yen, and yuan. Interest rates have been suppressed to historic lows for over a decade. Government debt levels are at peacetime records. The traditional rules of economics seem to have been suspended, and yet inflation is back. Not the mild, manageable inflation that central banks target, but the kind of inflation that erodes purchasing power, that makes people question the value of their savings, that creates political and social instability. In this environment, hard assets, things that can't be printed, that have intrinsic value, that have been stores of wealth for thousands of years, become increasingly attractive. Gold and silver aren't just commodities or investments. They're insurance against monetary chaos. They're a way to preserve purchasing power when fiat currencies are being debased. That's why central banks are buying gold at record levels. That's why billionaires and family offices are allocating to precious metals. They're not doing it because they think gold and silver are going to make them rich. They're doing it because they want to protect what they already have. And silver, with its dual nature as both a monetary metal and an industrial commodity, offers a unique proposition. You get the monetary premium that comes from being a store of value, plus the industrial demand that creates a fundamental floor under the price. Think about it this way. Even if the monetary premium disappeared entirely, even if nobody wanted silver as an investment, the industrial demand alone would support a much higher price than we're seeing today, given the supply constraints. That's a powerful combination. As we wrap up here, I want to leave you with a few key takeaways. First, the silver market is in a structural supply deficit that's now in its 5th consecutive year. This isn't a temporary imbalance, it's a fundamental shift driven by surging industrial demand and constrained supply. Second, we're at a critical technical level right now. The next 48 hours will likely determine whether silver breaks out to new highs or pulls back for another test of support. This is a decision point. Third, institutional money is starting to flow into silver. The commercial traders have stepped aside, the managed money is building positions, and the smart money is positioning for higher prices. Fourth, the historical parallels to previous silver bull markets are striking, but the fundamentals today are actually stronger than they were in 1980 or 2011 because of the industrial demand picture and the depleted stockpiles. Fifth, the paper silver market is many times larger than the physical market, creating the potential for a squeeze if physical demand overwhelms the system. And finally, timing matters. The best opportunities come when there's still uncertainty, when the outcome isn't obvious yet, when you have to make a decision based on fundamentals rather than following the crowd. This 48-hour window represents one of those moments. The market is at an inflection point. The fundamentals are aligned. The technical setup is in place. The institutional money is moving. What happens next will depend on whether buyers step up and push silver through this resistance level, or whether sellers defend it and force another pullback. But one way or another, this moment matters. The window is closing. The decision point is here. And whatever you decide to do, make sure it's an informed decision based on understanding the full picture of what's happening in the silver market right now. Because opportunities like this, where fundamentals, technicals, and market structure all align, don't come around often. And when they do, they don't last long. The next 48 hours will tell us whether this is the beginning of silver's next major bull run, or whether we get another chance to position at lower prices. Either way, the underlying story hasn't changed. The supply deficit is real. The industrial demand is growing. The monetary environment favors hard assets. This is your moment to decide. The clock is ticking. Clock is